Hello, hello. Welcome to tonight's session. I'm excited to be here. But listen, we got football on soon. So we're going to start exactly in 2 minutes, and this is going to last roughly 1 hour. I promise we're going to try to fit all 80 slides into 60 minutes. So if you have questions, please leave them until the end. I will answer them if there's enough time. If not, I'll get back to you on the market research side. All right? So we're going to start here in about a minute and a half. Grab some water and be ready to listen fast. I'm telling you, we're going to be flying through these slides. There's so much good information, though. I'm very excited to share it with you. As I was talking to the guys earlier today inside of the Discord, there are a lot of incredible looking charts right now, and there's a lot to be excited for over the next couple of months. So I'm excited, man. I really do think the next 3 months through the end of the year is going to end up a lot like last year, but possibly better. I'm stoked. For those of us inside of TTI that have been accruing positions over the last few weeks, those are up huge today. Just imagine what they're going to be worth if the market plays out the way we expect. Come November, December, we have those January, February contracts on the books. They're already up and over and free for us. Just imagine the possibilities. So we'll see here in a second when we start. For those of you that are joining us for the first time, you're not inside of TTI, I'm going to drop a link inside of chat. If you like what you see, click on the link, pay for a quarter. If you don't like it, email me. We'll cancel you with no questions asked. But if you like what you see today, I think you're going to like what you see on the inside. It's basically everything we do here times 100. Trade ideas go out every single day. Write-ups go out every single day. People that take advantage of stuff that we're being able to do that have a longer time frame when they're trading tend to do very, very well. Okay? So there's the link. It's in chat. Click on it when you're done if you like what we do, and I'll see you inside. Without further ado, like I said, this is going to last 1 hour. Welcome to tonight's mid-monthly chartathon, September 19th, 2024. We're navigating the end of summer volatility. End of summer is here. Disclaimer. Don't be stupid. Don't risk more than you can lose. And please do not misconstrue anything we say today as buy or sell recommendations. We're just looking at charts. Let's talk about the elephant in the room. Rates. Yes, the Federal Reserve finally cut interest rates. Everybody expected the market to fall. We did not, for good reason. We have data on our side. If you look at the last 5 times the Federal Reserve has cut interest rates after a hiking cycle, 3 of the 5 have ended with massive pops in the market. Now we're going to go over why that might be different than what you see in 2001 and 2007. But if you're inside of TTI, you were well equipped going into yesterday's Federal Reserve decision. Were you not? Can I get some hell yeahs in chat? We were not afraid that the market was going to fall into a brand new bear market. The data did not recommend that, right? And it really comes down to, and I know the guys that have been here for over a year are going to roll their eyes. It really comes down to this general idea of secular bull versus secular bear. What type of market environment are we currently trading in? These secular trends last decades. They're not years. You can have bull and bear markets inside secular bull and bear markets. The secular portion defines decade-long trends. As you can see, these red rectangles identify secular bear markets. The uptrends represent secular bull markets. Guys, when you find yourself trading within one of these types of markets, and once again, for a decade, the game plan changes. You cannot take data, for example, 2001 and 2007, those rate cuts, and apply it to what's going on right now. Because in secular bear markets, the Federal Reserve and other central banks around the world are caught playing defense. You're constantly cutting rates to avoid recession. In secular bull markets, it's completely different. You're more often than not cutting rates for offensive reasons. And we expected yesterday, did not know if it was going to be 25 or 50 basis points, but we expected yesterday the Federal Reserve to come out and say, listen, we're cutting rates for an offensive reason. And if you listen to the presser, the very last thing Mr. Jay Powell said was, we do not see a recession coming. We are cutting rates because we have hit our goals. Guys, If you traded in the 90s, which a few of you inside of TTI have, can you please tell me what happened from 95 to 2000? The dot-com bubble. Yes, it exploded. Yes, this market will probably explode as well. But if you weren't long for 5 friggin' years and you were short, you missed out on an incredible amount of money. And that's basically what we're seeing right now. We are in year 2 of this bull market, starting to get into year 3. And this is what we're looking at from a U.S. sector performance year to date. Utilities are leading. We would expect them to start to underperform as rates come down because it'll give other areas of the market an opportunity to outperform, specifically higher beta areas. Communications just breaking out into all-time highs today, up 23.42% on the year. Financials up 22.5%. And then you have industrials, tech, a bunch of other slew of sectors that are right underneath that benchmark, which we expect to rally over the next few weeks into new highs. A couple of them already are today. It's been a great year to be long. Going back to those August 5th lows, that was when the Japanese yen trade blew up. Everybody was afraid that the market had peaked, right? Everybody, the media, on both traditional TV outlets, you got the radio, you got FinTwit, you got TikTok, all of these people saying that was the top, this has to unwind. Listen, I don't care what anybody has to say about any of this. Prove it to me through price. And what did we see off of that August 5th low? A massive reversal. So what did we do inside of TTI? While we didn't buy the absolute bottom on the 5th, we started accruing new positions over the coming days because we realized this is not a dead cat bounce. That was a potential low. And if it turned into a low, which it has as of today with the S&P 500 closing at all-time highs, the opportunity cost of not owning new positions is huge. And now we have those positions on the books. Many of them are up and over 100%, and everybody else is going to have to play that catch-up game. So that August 5th is very important for us. And look at what's leading off of the low. Consumer discretionary, tech. I mean, these are higher beta areas of the market, but in particular, consumer discretionary. We're going to look at that in particular in a second, but that was the big lagger over the last 2 years. The growth sectors of the market, tech and communications, both breaking out to all-time highs. Consumer discretionary, for whatever reason, lagged behind both of them. That is the catch-up trade to take in Q4. That's why we've opened up a bunch of consumer discretionary exposure over the last 2 weeks. And what are we seeing today? 2-year highs in consumer discretionary, and it's outperforming other areas of the market. I expect that is going to continue because trends tend to trend longer than most people expect. Year-to-date performance from an industry standpoint, semiconductors are still the king, but there is a lot of caution right now with semiconductors, a lot of overhead supply. We're going to look at that chart in particular in a second. As of other areas of the market that were long, though, gold miners, we have that position in gold in particular. It's up over 150% right now. We have some gold miner exposure. Look at home builders up at all-time highs today. If this was a recessionary market about to roll over, please tell me why home builders are at all-time highs. It doesn't make sense. The world is afraid the market's about to implode. Why the hell are home builders trading at all-time highs? You see everything underneath the S&P 500, but off those August 5th lows, look what is leading. Higher beta areas, other than jets, which we're going to get to in a second. Who had airlines leading off the August 5th low? Not me. When I pulled this data up, I did not expect it. Now I went back and looked through all the different major airline stocks, and the majority of them, particularly the liquid trades, not that great of a trading vehicle right now, but it does throw up on our watch list now. They are starting to show up on the 50-day highs list, so these are very important stocks that we could be owning relatively soon. But check out the higher beta areas. Software up 14.67%. Internet up 14.23%. Semiconductors up 14.15%. These are areas that we want to own, particularly software and internet. We want to own those names, and that's why we've been opening them, right? This is fantastic to see off the August 5th low, and also this is what we want in a bull market, right? Stocks can go up when higher beta areas of the market are not, but it doesn't go up as cleanly. People get frustrated. As a matter of fact, this summer is a great example, right? We had lots of areas of the market hitting all-time highs, staples, financials, industrials, materials, healthcare, and yet people were tapping out. This market's topped because their favorite tech stock wasn't playing along. Well, now all of a sudden, tech's starting to play along. They have egg on their face, right? Maybe they sound kind of stupid. They threw in the towel a little early. They didn't want to hold through the summer volatility that was very well documented. And now they're obviously faced with having to play the catch-up game here. Factor analysis year to date, We talked about this during the summer. Mega cap tech and growth in particular tends to have a hard time throughout the summer. You see it peaked in July and it's been basically down since then in a relative basis against the broader market. It gave other areas of the market an opportunity to pop up. We took advantage of those. We have positions in those. Many of them are already free, which is great. We don't need to close them. They will probably continue to go up along with the broader market. But what we're looking for are market leaders, right? We don't want to own the positions that might lag behind the benchmark, at least new positions that are going to lag behind the benchmark. What we're seeing right now is an uptick in higher beta areas, large cap growth, small cap growth, mid cap growth, right? So is it the right time to go and open up new positions in energy to the long side? Is it the right time to go open up new positions in consumer staples with large cap value starting to underperform? No. It's all about opportunity cost. Higher beta growthier areas of the market are now starting to outperform, and we can really see that off the August 5th low. Large cap growth, small caps in general, right? So there's questions inside of Discord today. Should we be looking to open up some breakouts in Verizon? Hey, that's a green lit trade. There's absolutely nothing wrong with that. A potential stage 1 into a stage 2. But that's a 1.5% ADR. Listen, you could do whatever you want, but I would prefer to own something like a 3 to 5% software stock because that's what the market is really starting to gravitate towards. And while Verizon will probably work, stage 2 are great opportunities to own. Think about what's going to work better over the next 3 months. What has the higher probability odds? It's not Verizon. I'm not saying Verizon won't work, but that's not where our focus is going to be. Let's bring this chart back really quick because it's important right now. We looked at this for the last month. Technology sector versus the S&P 500. Now, this is a relative chart, not an absolute chart. So what we're looking at is the tech sector against the S&P 500. Look at those previous 2000 highs. We came up, we tapped it, we found resistance. Asked you guys, is that a big surprise? No, it shouldn't be. These types of relationships happen all the time. What would be a surprise is if we roll over into new lows here. That would probably mark the end of this bull market. And we were talking about it a month ago. It could have happened. Absolutely could have. But it doesn't look like it is. As a matter of fact, what it looks like is what semiconductors did. Semiconductors came up, tapped that ratio, that relative performance against the S&P 500 back to 2000s. It consolidated and then blew right past it this year. That's what we're expecting to happen with tech. If this is a bull market and it's going to continue, you cannot assume tech rolls over. That's it. If you're assuming tech is done, the bull market is over. There has not been a bull market not led by tech outside of the secular bear market of 2000 to 2013. We had a couple years in those 2000s where utilities, financials, and energy led. Outside of those years, tech leads. So if you expect that tech area to roll over, this bull market is a ticking time bomb. It's going to implode. We're not seeing it, guys. We are not seeing it. As a matter of fact, it looks like, and it's weird to say, that it's just about to get going for tech versus the S&P 500. It blows my mind. But once again, we don't trade based off biases or opinions. It's only price. What are we seeing with the charts? Once again, there's your tech versus S&P 500. And here you have your semiconductors against the S&P 500. Relatively the same. We're expecting tech to break out against those 2000 highs and head into new all-time highs. A couple weeks ago, 3-4 weeks ago, we talked about this chart as well. Semiconductors. Now, this is on the daily. This is zoomed in. Semiconductors against the S&P 500. Big question. Was this a head and shoulders? Could be. But the implications of this were that if this broke to the downside, this bull market was under duress a lot. If semiconductors, which were the market leaders over the last 2 years, start to break down, guys, the market is probably going to not continue to go up. It's eventually going to start breaking down as higher beta stocks take a backseat to lower volatility. And eventually the weight of the evidence starts to crumble in on this bull market and people start to sell and freak out. And you see risk off assets really start to fly. But here we go. We stuck it, which is not all that surprising in a bull market. Markets love to do that. They stuck the support area where they needed to stick it. Now, what we expect for semis is to once again outperform, but this is very close. I'm not ready to throw cash up on this. I haven't opened up any new semiconductor positions in a long time. I'm sitting in some free NVIDIA plays for January that we opened up on August 6th or 7th. Other than that, I'm out. I want to own it, but until it proves to me against the broader market that it wants to lead right now, I'm just simply watching. Remember the implications though. If you think tech and semis are rolling over, this bull market's probably over. If you don't, party on. S&P 500 on the weekly, all-time highs. Here's a question I asked you guys inside of Discord today. When we originally posted this chart back in January, it was at 478. We said, listen, What are the odds this hits 555 by the end of the year? Most people inside of TTI said it's doable, but let's be honest, did we expect it to happen by July? No. 6 months? It took 6 months for the market to hit our first price target, that 1.618 fib extension. Insanity to me. That just goes to show you the strength of the bull market. Then it consolidated sideways for 3 months, and now we're breaking out again. For those of you that have been with us for more than a couple years, 1 or 2 years, this is a patented continuation fractal. You want to be long. Shorting all-time highs is a very tough way to live in the market. Don't care who you are. You're going to lose more often than you win. If you hit the absolute top, you bet everything, you're going to make $1 billion, but most people are not. Trade with the trend, all-time high, S&P 500, congratulations. Looks like it's going a hell of a lot farther. NASDAQ, look at the summer of 2023 versus the summer of 2024. I tried my hardest over the last 2 or 3 months to ingrain this image into your head. Summer volatility sucks. If you can't handle the heat, get the fuck out of the kitchen. Don't trade. Go golfing. Go to the beach. Reduce your position size. Do anything other than commit capital and like lose your mind as the market chops around. And here we are, potentially starting to get on the other side of it. We still have a couple weeks left of this normally volatile part of the market, right? It generally clears up by the beginning of October. Still have about a week and a half to go. But don't those two fractals look relatively the same? And I challenge you, go back over the last few summers and look to see if price action was choppy as well. I'm going to tell you it was. It happens. It's seasonality. We understand this inside of TTI. So what do we expect is going to happen? The S&P 500 consolidated underneath its 1.618 fib extension and eventually broke out. What do you think is going to happen with the Qs? Once again, if you don't think the Qs break out here into all-time highs and this is a double top or whatever random chart pattern you want to throw on it, the implication there is the bull market is over. There is no bull market without the NASDAQ breaking out along with the S&P 500. My money is on new all-time highs relatively soon. The Russell 2000 and small caps breaking out into 2-year highs. Can't get more risk on than this. It's been a very, very tough 2.5 years for small cap traders. This is your opportunity. Think about the implications of a Russell 2K near all-time highs by year end. Could it happen? I think it probably could. And we're going to continue to open up exposure into small caps as we break out into these 2-year highs. Things look great. Mid caps, all-time highs this week. That's all I got to say. Mid caps, all-time highs. Dow Jones, all-time highs this week after consolidating at the first fib extension. Transportation, looking like it wants to finally break out. We have yearly highs. Finally, what are the implications of a market where the transportation average and the industrial average break out together into all-time highs? That's a motherfucking bull market. You better be long. Charles Dow told us this 120 years ago. Be long. That's all. Be long. We'll see. Airlines help. S&P 500 net highs versus lows on the weekly. By the way, if you haven't noticed, none of this is my opinion. I'm going to say that 57 more times. It's all based off of charts and price. You don't like it, take a hike. I don't like half the shit I trade, and I trade it and make money more often than not because I don't have any ego in it. There's more highs than lows in the S&P 500 on a weekly basis. You don't like it, take a hike. Qs, net highs versus lows, hell of a lot choppier than the S&P 500. We had multiple sectors breaking out to all-time highs this summer. Not many of them were coming from the Qs. Now all of a sudden we see new highs start to expand as the market breaks out from this federal interest rate decision. What do you expect is going to happen over the next couple of weeks? Where do you think this histogram's going? I would say a lot more green. Volatility is back to decade average under 20s. Listen, guys, general rule of thumb, below the 20 VIX, it's okay to buy calls and puts. Above the 20, you might want to be careful. We're below the 20 and decade average is around 12. It would not surprise me to see us float back down towards that 12 spot, but it's not going to happen all in one night. We're still, once again, in that seasonally volatile period of the market. Stocks above the 20, 50, and 200-day moving average. This is very, very simple, guys. Very, very simple way to look at short, intermediate, and long-term trends. 66% above the 20-day, 73% above the 50-day, 75% above the 200-day. Once again, you don't like bull markets, take a hike. Everything right now is screaming to go long. Puts versus call ratio. We did have a spike into the lows. There's not really a whole lot of information here. Preferably would have liked over one here to potentially have a bigger squeeze, but that's okay. We don't need liquidity to squeeze. We can simply just go higher based off people sitting on the sidelines. High beta stocks looking to push out into all-time highs. Finally, how many charts have we sat through this year where we've seen sideways consolidation up and over previous cycle highs? Finally, higher beta stocks want to contribute. This is very bullish. That's why we were just having the conversation 10 minutes ago. Lower volatility versus higher beta stocks. What do you want to own going into the end of the year? Higher betas for me. Opportunity costs caught up inside of low volatility, but I still want to point out lower volatility stocks are still hitting all-time highs as well. You can't go wrong being long anything, to be honest. You're probably going to make a couple bucks on everything, unless you're trading something inversely correlated, right? Low volatility stocks, all-time highs. Higher beta stocks working on all-time highs. And this very important intra-market relationship that we have followed for years, higher beta versus lower volatility, is working its way back up and over that previous point of contention. And if we break out above that with higher beta breaking out, all hell goes loose. You better be long higher beta stocks. That's a very important chart. TTI, you're going to see that a lot. XLY against XLP, you're looking at your discretionary versus staple stocks. We look at this every single week. What's it screaming at? Well, a couple weeks ago, it was telling us if we broke down out of this rounding top pattern, probably a bad omen for this bull market. But just like semiconductors, it stuck its support where it was supposed to. Consumer discretionary is now outperforming consumer staples. Bull market is back on, boys. Own the stocks. High yield corporate debt versus treasuries bounced where it need to. There's no recession. If the smartest and most liquid investors in the world are buying high yield corporate debt, I don't give a fuck what anybody says. They are not going to go out and buy the riskiest corporate debt known to man if they expect this market to roll over. You don't like it? Take a hike. SPY versus gold. This is a little interesting. Stocks versus rocks. Gold has performed very, very well along with stocks. This is not normal going back 30 years, but it has happened in history. Gold and stocks going up at the same time. It has happened throughout history, just hasn't happened for 30 years. This is a new phenomenon, a new relationship we want to keep an eye on. That's why we're long gold and stocks. Check this out. This is your SPY and your gold going back to 2020. Two different paths, same destination. Isn't that crazy? That's something you don't see every day. SPY and gold working together. The dollar, arguably the most important chart in the market. I've said that for about a year and a half straight. It still remains inversely correlated to the S&P 500, the broader market. Dollar goes up, stocks go down, right? Stocks go up, dollar goes down. What does this look like? This looks like if the dollar breaks below 100, that is an uh-oh moment for the dollar and an oh hell yeah moment for stocks. That's what we're looking at right now. This breaks support. 2 years, we are now completing a stage 3 into a stage 4 decline. Hold your butts if you're long the dollar. Buy the stocks. Buy the stocks. Here's that inversely correlated relationship shown to you. Black line dollar, magenta line SPY, blue line correlation coefficient. The closer to -1 it is, the closer the exact opposite they are. Dollar go down, stocks go up. Dollar go down right now, buy the stocks. Pretty simple, right? All world country weekly. Hey, guess what? It's not just the United States breaking out into all-time highs for anybody that trades stocks outside of the United States. TTI does. How about you? They're at all-time highs right now. How about that? Here's your China stocks. Here's something that we haven't done for 2 years, at least consistently. Sunk capital into Chinese stocks. They suck. They continue to suck. You don't like it? Take a hike. We want to own them above 33.5. That's our line in the sand. Huge amounts of opportunity cost owning Chinese stocks. I don't give a shit how good they look. On an individual basis, we own them when the sector breaks out. China has been so bad. Here's your emerging markets ETF with China in it. Yes, holding not previous cycle highs, resistance area highs through the bear market. So more bullish than bearish to own emerging markets. But I don't think I added it. I did. Emerging markets without China. Check out the overperformance. China sucks. If you're stuck trading BABA, you got to reevaluate your plan. If you're stuck buying crappy stocks like NEO and everything else, evaluate your plan. Use some sector strength. Look at the ETFs. The market looks great outside of China. As a matter of fact, let's check this out. A majority of the world is in a bull market. We go back to the bear market low of October 13th, a Thursday, 2022. Check out the Americas. Argentina's up 150%. Peru's up 77. America, God bless, is up 60. Look at the rest. Nearly every single American ETF, meaning North and South America, is in a bull market outside of Brazil, which is where I'm at. Brazil sucks. Don't invest in Brazil. Check out Europe. Wow. Bull market across the board. Check out Asia. Wow. By the way, GXC is China. Look at everything else outperforming China. Stop buying Chinese stocks until they perform. Majority of the market's in a bull market. You don't like it, take a fucking hike. Equal weight S&P 500 all-time highs. If market breadth sucked was the reason to not buy the market, well, market breadth has legitimately never been better. You better fucking buy it. Price target there, 186.50. QQEW chopping around. What are the implications if this breaks out to all-time highs? We saw the Qs. Qs look like they want all-time highs. How many times have we seen charts break up and over those previous cycle highs and then chop sideways? We just saw mid-caps do it. We saw the Russell 2000 do it. We saw equal-weighted S&P 500 do it. We saw mid-caps do it. Now we see equal-weighted Qs do it. Where do you think this resolves? Higher or lower? And what are the implications? Probably going higher. That's great for high beta stocks. Bonds, we continue to think have bottomed. Buy the bonds. We have bonds. We have bonds going out to January of next year. We have March of next year. We have January of 2026. Bonds continue to look like they are bottoming. Bonds and stocks can go up at the same time, by the way, in inflationary environments. I'm not sure if you've noticed, but we're in an inflationary environment. Deflationary environments, stocks and bonds are inversely correlated. Inflationary environments, stocks and bonds are correlated. These look like topping patterns in yields. If you don't think bonds are going to break out, these should not resolve to the downside, right? Yields are inversely correlated to bonds. That's how this stuff works. If you don't think these are topping patterns, don't buy the bonds. If you do think they are, buy the bonds. And here's those bonds. Do those look like bottoming patterns? Shout out to high yield corporate debt. Do you think sophisticated investors worth billions of dollars are buying high yield corporate debt because they're afraid of a recession? I don't think so. Your favorite FinTwit influencer does, though, and he'll call you an idiot if you disagree. But I don't see him managing billions of dollars, so fuck him. CTA's lowest exposure level since January of 2024. That's not true. I forgot to update that. But I will tell you, once again, CTAs were caught off guard into the all-time high. They are less exposed to the market. CTAs are professional money managers, less exposed to the market right now than they were previously throughout the year, and we're at all-time highs. What do you think happens next? They'll be forced to buy higher. Listen, little anecdotal evidence. How many professional money managers do you follow on social media? How many do you think fit this description? So when they tell you don't buy stocks, they're too expensive, this market's got to come down, you know, the old fucking doomer stuff, they're in this category, constantly chasing all-time highs. Just remember that when they're shouting out their opinion on Twitter. Follow charts, not other people's fucking opinions. Different flavors of market breadth signaling bullish momentum. We already looked at moving averages. Here's my total market breadth indicator. Very obvious. If it's above zero, it's more bullish than bearish. If it's oscillating above zero, it's a bullish momentum regime. If it's oscillating below the zero, it's a bearish momentum regime. Here's your bear market. Here's your bull market. You literally cannot get more bullish than right now. Own stocks. Here's your risk on versus risk off assets, another indicator that I built. 2 baskets of different stocks, 1 basket showing you risk on, the other basket showing you risk off, divided the 2. Listen, this trending higher is good for stocks. We are holding previous cycle highs. I would not be surprised to see this at all-time highs within the next month. And if that's the implication, own stocks. Mag 7 stocks are taking leadership role again. We are very aware. We have lots of exposure. Congratulations. There it is again. I loved it so much I put it in twice. Let's talk through some sectors. We're making good time. Normally I rant for about 90 minutes. I'm really trying to speed through this. Communication sector. Hallelujah, all-time highs. We did it, boys and girls. We got it. We stuck it. Check out the chart. Same thing we've seen across the market. Coming up, tapping previous cycle highs, consolidating sideways, giving us the all-time high breakout. Meta, all-time high today. Claps in chat. Good job. You guys have positions. For those of you that don't, there's no opportunity here unless we get a nasty pullback to 525. Interim price target is $600. Nice big round number. Next price target up, shoot for in between 600 and 700, but ours is $700. Netflix all-time highs today. We do have a position. You can tail it if you want. January 17th, 2025, 850, 900 call debit spreads for no more than $8. That's $800 per position if you want it. Contracts by themselves, calls, very expensive. You can also do that. Price target up near $900. We like this all-time high breakout, bullish momentum regime, trading north of an upward sloping 200-day moving average. Buy the all-time high breakouts. It'll work until you fucking die. All-time highs are bullish. Spotify, all-time high. Bullish momentum regime, 200-day moving average, sloping to the upside, big blue skies. We want to own it. January 17th, 2025, 420 calls, no more than 12 bucks. Also a great shares trade. A great shares trade. One of the few large caps with over a 2% ADR. So if you're trading shares with a large account, this is also very good. Our price target's out there. We're swing traders, boys. We're not day traders. Go for it. Roblox is setting up finally. This has been on our watch list for 2 years. Stage 1 into a stage 2. We have not owned this for over 2 years. Congratulations. Another clap in chat. We don't buy shit underneath overhead supply. It keeps us out of trouble. Roblox 48's the trigger. We want to own $60 January 17, 2025 calls. No more than $1.50. It's cheap. Starting a bullish momentum regime, trading upwards of above an upward sloping 200-day moving average. We're not there yet, though, so be very wary of front-running this. We want it to close above 48. Price target's 62.85. And, of course, Google. This is the big one. We were able to snag this off of that proprietary gray box you see there at 152.50. We have current contracts up going out to January. They're already free. This is what I'm talking about, boys and girls. I am so ecstatic that we were able to buy shit when everybody else was screaming the world was falling, because now these guys have to play catch up and we have no risk against our positions and they have to hurry to own this stuff. That means if the market whipsaws near all-time highs, which it typically does, we can sit comfortable knowing our positions have no risk against our accounts. Isn't that fantastic? Exposure through the end of the year. You can tail us if you don't already have this. January 17, 2025, $180 calls for no more than $1.50. Is that right? I don't know if that's right. I think I might have not updated the price on that, but that's the call that we got. So go ahead and check that. We're already in it. It's already free. Congratulations. Price target, obviously, all-time high is 195. Consumer discretionary. This is my big trade for the next 3 to 4 months. I think this is the trade to make. Talked about it inside of TTI for the last week. Posted about it yesterday on social media. I think it's the catch-up trade, 2-year high consumer discretionary. Let's go ahead and look through some of the best stocks in the sector. Maple Bear, we opened up yesterday and today. I did not. I have egg on my face looking for a pullback. A bunch of you guys did open it up. Congratulations. Now, this is only up about 40-50%, I think. So there might be a pullback in store for CART. Congrats if you already have it. I do not, but price target up there at 45. For those of you that do have it, if it doesn't pull back, you're inside TTI. Do not sell the whole position at 44.5. That is all-time highs, and you have until January. For the rest of us assholes, January 17, 2025, $45 calls for no more than $2 as of right now. They're overpriced. We'll wait for a pullback. Good job for those of you that took them and got in early. Coupang, we love it. February 21st, 2025, $25 calls for no more than $2. We love this stock. Stanley Druckenmiller's second largest position on his portfolio. Stage 2 uptrend here. Trading north of a 200-day moving average. Bullish momentum regime. We like it. Shark Ninja, one of those stocks that I had absolutely no idea was going to break out and run the way that it did. This is our IPO range breakout high setup that we have traded all year, and it has like probably the highest performing setup that we have this year. I mean, these have just absolutely returned monster gains. We're in the October 18th, 2024, $95 calls. As you can see, we have a position already. Allen up 464% on this particular position. If this pulls back to $100, look to open up more. Don't stop out of this position until it shows you a topping pattern. Add in at every single level that makes sense. This stock is a fucking monster. Shark Ninja. Lowe's, this just went out yesterday or 2 days ago. I like it. This is one of my top plays for consumer discretionary. Just like Home Depot, just like Amazon, these are basing right underneath overhead supply. I like this. It's clean. I don't know if it's going to outperform shit like Tesla, but it's an easy trade. You know where you're right and where you're wrong. Where are you right? Above 261.5. What's your price target? Above $300. Where are you stopping out? Underneath $241.50. It cannot be any easier than that. It's easy. Not saying it's the best, but it's easy. Trading north of an upward sloping 200-day moving average and in a bullish momentum regime, we want to take the January 17, 2025, $290 calls for no more than $5. We like it. Low IV into all-time high. Very, very good. Amazon, we just started opening up as well. Listen, guys. Consumer discretionary is not going to outperform over the next 3 quarters or 3 months, if Amazon doesn't break out. It's not how this works. I'm assuming Amazon breaks out. You look at its Latin American cousin, Mercado Libre, same setup, broke out into all-time highs. Consumer discretionary 2-year highs. Amazon's got to do it. It has to do it. January 17, 2025, $220 calls for no more than $4. I'm already in it. I didn't wait for the $190 breakout. I'm in it. It either breaks out or it doesn't. I'm under the assumption that it does. Price target there at 225 and then 250. Let's look at some tech plays. Yes, tech probably will be back up at all-time highs relatively soon tomorrow. Maybe not next week, maybe not. Implication here of it not going back to all-time highs. Very choppy bull market. If it starts to roll over, bull market over. I'm assuming it continues higher. How about this stock? Arista Networks, ANET. New all-time high today out of a rounded bottom. Want to own it above 371.50. Did not put an options trade on here because we want to wait for it to pull back. Options contracts are severely overpriced right now, given the last few days. But this is the market leader in cybersecurity. This and PanW, right? Palo Alto. This has been a monster stock for us. We did have an open position on this at the beginning of last year. It worked okay. Unfortunately, we didn't buy enough time on it, but this is our opportunity to get back into ANET on a pullback. Inside of TTI, we'll be very ready to buy the pullback. Options trade will come out when it does. AppLovin, another one we've owned all year. Probably the biggest single position we've owned in terms of money, right? We've owned multiple 1,000% winners this year. We're in it right now for 1,000% win. As you can see, Brian's in those Octobers. He's trimming into strength. But what we're looking for here is a pullback at this point. I know everybody inside of TTI, you don't want to hear me say pullback, but there probably will be a pullback to that all-time high pivot at 120. And if that's the case, we start to build a base. We want to get more long app. You don't stop trading market leaders until they prove that they're done leading. This, if anything, has proved to you need to stay with it, right? So we're looking to buy pullbacks in app towards that $120 area. Winner, if it does pull back, it's only $3 or $4. We'll look at the options plays then. Once again, congrats to those of you. This was the first 1,000% winner for a lot of you and the second 1,000% winner this year for many of you. So congrats. App has been a big winner for us. CORZ, Core Scientific, started off as a Bitcoin mining name, transitioned into an AI-related name. We've owned this since 425. That's my position down there. Those January $5 calls up 560%, but I'm looking at loading more here across this 11.5 pullback today. January 17, 2025, $16 calls, no more than $1. IV slightly elevated. Just keep that in mind when you go to allocate how much you want to throw into this. But big blue skies, price target $16, $16 calls, lots of open interest. I like it. I will be adding in to this play. This is a big winner for me. I'm happy to have held it. Clearwater, this is not something we can particularly add here. This is just to show you guys to buy these range breakouts and don't be afraid for pullbacks. If you want to add in on those pullbacks, feel free. Run tight stops. This is a 9-to-1 risk to reward that we opened up and it's working for us. 9-to-1. For every dollar you risk, you're going to make $9 at the price target. That is what we fucking do inside of TTI. None of this knick-knack bullshit. We don't close stuff at 20%. We're hitting home runs. We're protecting risk or the trade's dead. That's how swing trading is done. Consistent swing trading. We don't just arbitrarily close. C1, good example of that position. If it does break above all-time highs, somewhere near 27-ish, we can talk about maybe entering in there. I'm assuming there's going to be some overhead resistance here at that all-time high just because it was all-time high. But that was just thrown in there as an example. Palantir, we own it. We're up. Free position up and over 100% on those Novembers. Good job. That's all I got to say. Nobody wanted to own Palantir at the 27.5 pivot, but we did. This is a big win for us. We're looking to add in above $40 a winner if it gets there. It's currently trading 36. Current position we have on the books right now are the November $40 calls. Those are up absolutely fucking huge. They'll be up even more if we get up to $40. We don't have to manage them. When we open up the new position, we can open up a new tranche individually. What we're going to go for, obviously, is extend the play out. January 17, 2025, $50 calls, no more than $1 right now. You want to front run that? Be a maniac, be my friend. I'm going to wait. This is a big trade for us, but we want to continue to add into it. Palantir is a winner. Uber is a winner. January 17, 2025, $90 calls, no more than $2 right now. This is multi-year highs. As long as we held that 64 level, we wanted to stay long Uber. It's continuing to prove to us that it wants to hit new all-time highs. We want to continue to own more. For those of us in those December plays, we might not want to add yet. For those of you that are looking to add into a market leader breaking out to new highs, Uber very close to an all-time high. Price target $95. Those $90 calls are cheap at $2. And what could can't wrap up tech without Apple. I don't care what you read about the iPhone. I don't give a shit if you like iPhone. Apple's probably going to be at all-time highs. It's hard to have a bull market without Apple participating. We're already long Apple, like October, November, December, and January. They're all up except the January plays. We're looking to load the January 17, 250 from no more than $5. Already in that play for us, so if we want to continue to add into that, we can. Implications of Apple breaking out to all-time high. Price target is that 250 area, right? Makes the most sense to me. Continue to watch Apple. Good job on that right now. I know we have a huge win in it. Real estate. Listen, this is a 2-year high in real estate, guys. 2-year high in real estate. Own real estate. Nobody wants to own it. We do. We're in real estate. The real estate sector ETF calls in of itself. It's very hard to get long this particular part of the market because of liquidity issues on the chain. So we just went out and bought the $45 calls, right? Already up and over, and they're free. We have until January to own these. Try to find ways to get creative and get long real estate. Zillow, how about that? We're long Zillow. Stage 1 and 2 is stage 2. We wanted to own it above 61.5 with a price target at 84 to 85 bucks. We bought the $80 call for January. It took 2 days. It's already up and over 100 bucks. This thing can do whatever the hell it wants for the next 4 weeks, and I don't give a shit. It's free. There's no risk against our account right now. Bullish momentum regime, trading north of an upward sloping 200-day moving average. If there is an opportunity to add this, it's at a pullback to 61.5 for those of you looking to get into Zillow. Buy the same contract, January $80 call. It worked. It's probably going to work again. It's a good contract, but only buy it if you get a pullback because they're already overpriced. Loved it. I put it in twice. How about Redfin? Everybody wants Redfin because it's a more explosive play. Smaller market cap, higher beta. I get it. From a shares perspective, there's a lot of opportunity here on Redfin. It's relatively the same setup as Zillow. It's our stage 1 and 2 potential stage 2. You want to own Redfin. My line in the sand is like 13.20, 13.25. Price target's 19 and 28. That's what I would do. Starting to show a bullish momentum regime. 200-day moving average is starting to slope to the upside. I think it's a weaker play than Zillow, but it is a playable name. If you think Zillow's going to go up, decent chance Redfin's going to go up. I just think Zillow's the better trade. If you're an options trader, it gets dicey. You're playing in a 100 IV plus environment with Redfin. You buy straight calls, you run the risk of getting IV crushed badly. So if you want to do that, go out and buy the call debit spreads. You're going to hedge against that IV crush. You're not going to make as much money, but your odds of a winning trade go up exponentially. The 1820 call debit spreads for January 17, 2025, you can grab them right now for about 40 cents. Don't go over 40 cents. They're marking at 45 or 50. Do not buy them. You want a 4-to-1 or greater setup. Right now, 40 cents puts you at $160 in profit versus a $40 max loss. 4-to-1. That is the secret. I just threw this in here to give a middle finger to everybody that said the commercial real estate bubble was going to implode over the last 12 months. CBRE Group, which is the poster child for commercial real estate's trading at all-time highs. You can take your bubble and shove it. 10 out of 11 sectors are trading north of the 200-day moving average. If I haven't already painted a bullish enough picture for you, please go and look at it yourself. This is not bearish. When a majority of the market is trading north of the primary trend, it's probably better to be long and not short. You're not Michael Burry. You don't need to hold a short for 2 years. Gold, all-time highs. We talked about this earlier. Gold and stocks can go up at the same time. It's happened plenty of times throughout history. Just hasn't happened very often over the last 30 years. Global liquidity is rising. The Federal Reserve just initiated an interest rate cut cycle. There will be a shit ton of money flooding the markets from market funds right now. As interest rates come down and the dollar comes down, the opportunity cost of not owning hard assets goes up. It will find its way into gold. TTI members, we are long gold. Congratulations, we want to continue to be long gold. For those of you that like silver, if you want to own silver, my line in the sand is about 29 or 30 bucks. Sure, gold's the better trade, but some of you guys are stuck in your ways. You want a reason to own silver? It's because there's money that's going to be thrown into the market and it will permeate its way through to risk on assets. Silver above 30 bucks. Conservative price target 34, 35. Continue to scale the fibs if you want. I like gold better. Bitcoin, last chart for tonight. Told you I was going to fly through this football zone in about a half hour, right? Bitcoin, we have not touched it for months. Above the 200-day moving average, it gets interesting. Above 70,000, I'm a net buyer. I have not touched my position at all this entire year. The cut was 50,000 on a close. We tested it, didn't close there. Position is still on the books. We're not adding in below the 200-day moving average because we're smart, right? Things below the 200-day moving average tend to be bad investment and trading decisions. Thank you, Paul Tudor Jones. Very simple rule. But now that the Fed has signaled this interest rate cut cycle, Bitcoin is responding positively, and we're seeing risk-on assets respond positively. I wouldn't be surprised to see Bitcoin start to break over its 200-day moving average. Josh is going to come back and start talking about how it's starting to look good again. And then above 70K, we're back in business. We want to own more. Price target, conservatively, $100,000. Stock big theme here. Federal Reserve officially started its rate cut cycle. Congratulations to everybody that didn't pray for the downfall of the common man. The market did not fall. The market will probably not fall. Plenty of times throughout history, we talked about it on the third slide. Stocks at all-time highs, but sentiment is not. Plenty of people are bearish. You saw CTAs underpositioned. There's a lot of room to fly into these all-time highs. Trust me, the opportunity cost of not being long the market will eventually creep up to the worst bear in the market, and they will own more stocks. It will happen. Focus on high beta areas, consumer discretionary, tech, communications, low volatility stocks will probably perform well, but I proved it to you already. You probably want to own higher beta stocks right now. I'm telling you. The dollar breaking $100 could be a huge tailwind for stocks. We saw the inversely correlated relationship that is a 2+ year low and starts to signal a stage 4 decline. We don't want to own the dollar. We want to own risk on assets like stocks. By the way, aren't you glad you didn't short a choppy market? Good job. Seriously. That's all I got to say. Aren't you glad you didn't give in? Eyes on breadth, high yield bonds and small caps. Market breadth is better than ever, literally ever. Looks fantastic. High yield bonds are outperforming. That is not bearish. And small caps are about to hit a 2-year high. That's not bearish, guys. Get long. You did not get complacent. Remember the last few charting sessions? The last thing I said on the big theme, do not get complacent. Your biggest wins come after corrections. Do not get complacent. Your biggest wins come after corrections. Hello, you did not get complacent. Many of you are sitting in 1,000+% wins right now with a shit ton of new exposure already risk-free through year end. Your big wins are about to come. Congratulations. Thank you for entrusting me and trusting your own gut. If you have any questions, I'm going to hang around for about 3 to 5 minutes. I flew through that. A lot of stuff is going on right now. A lot of stuff. You want to own stocks. Any questions? Feel free. Going to look really quick at the market research portal. I just want to bring up one thing here. If you have any questions, feel free to post them. And I'm looking at chat here. Let's talk about. We talked about this a month and a half ago about how markets were responding differently under different market regimes. Hopefully this type of stuff you guys read through, it doesn't take very long. 3 to 5 minutes or less is what I usually try to go for. Bite-sized nuggets filled with informative information, right? That's what I'm trying to do. Hopefully this type of stuff helps you in the long run. At the very minimum, set expectations. It can get worrisome out there. The markets fell yesterday. The first thing everybody screamed was, that's a news failure. Markets are going to new lows. Markets should have rallied. That was fucking stupid. And then markets opened up this morning and flew into new all-time highs. Algorithms, everything up. People are going to try to take your money from you one way or the other. Don't listen to them. Look at history. Look at price. Look at data. These don't lie to you, right? I encourage you to go through and read this stuff if you're not reading it on a consistent basis. It's in your email every single morning. It's on the app every single morning. All right? Once again, if this is your first time listening to this type of charting session, you're interested in joining, link is in chat. Join for a quarter. You don't like it, tell me. I'll cancel you. No questions asked. If you do, which I think you will, hopefully you make a bunch of money. My name is Hamilton. I'm here with the Trading Initiative. Once again, if you like this type of content, please like and subscribe. Leave a comment below. Good luck over the next 3 months. We're going to be long until the weight of the evidence tells us not. That's how it goes. The market research portal, 1 to 2 emails per day. Show you what type of stuff like this. You can go through and you can read some of this stuff. I post some of this stuff publicly later on, but you can go and we talk through, what's the state of the market? Should we be worried right now? 2 days ago, prior to the interest rate cut, I asked, where are the new lows? If this market is about to break down, why are there no new lows expanding? We looked at risk on assets. With a lot of this stuff, particularly from a swing trading perspective, is just setting expectations. We had people like 2 weeks ago tap out. They were like, I can't do this. This is crazy. The market's about to roll over. It doesn't matter what I say if your mind is made up, but what I try to do is bake in as much information that I can for you to make your own decision. 2 days ago, I was sitting here saying, listen, there's no new lows. Markets are at all-time highs. Everything is signaling that the market is going to break out and continue into all-time highs. If you don't want to trade that, that's fine. You're telling me the market's wrong. I don't agree. I think the market is always right. I follow trends. That's what I do. So if you have a problem sticking trades and holding them for bigger moves, that's what we do. You can see some of the stuff here. This is what our trade ideas look like. This is that cart trade that we were just talking about 11 hours ago. So pre-market posting it. You have your entry stops and take profits. You have the options play. You have the commentary why we want it. All of this stuff gets shot out to you via email and app. It's a really efficient system. I like it. Okay, anyway, congratulations, TTI. Hopefully this has been a very good charting session. You're psyched for the next couple of months.